CPI increased by 3.5% year over year, which is no surprise if you've watched some of the other videos I've posted on this channel. In my opinion, the fact that the Federal Reserve has raised interest rates this past year is part of the reason why CPI is above their 2% target goal, at least their stated goal. I think the Federal Reserve knows this, but because shelter inflation is the biggest factor in their CPI number, and the higher that these rates are, the harder it's going to be to bring rents back down to that 2% goal that the Federal Reserve has. We're going to dive deep into that data and show you exactly what I'm talking about using March's CPI numbers that just came out today. We're also going to talk about what this means for mortgage rates. I do think this is going to push mortgage rates back up at least slightly. We are seeing the 10-year Treasury increase. It increased by almost 20 basis points today, and that is going to put upward pressure on mortgage rates. But at the same time, the spread between the 10-year Treasury and the best 30-year fixed rate mortgage rate that you can get out there is down from its all-time high. We saw it at about 3% above the 10-year Treasury this fall, when in the fall of 2023, the 10-year Treasury was at around 5%. We saw mortgage rates around 8%. Now we're seeing the spread between those two numbers at about 2%, where the 10-year Treasury currently sits at about 4.5%, give or take, and mortgage rates sit at a little above 6.5%. So the spread between the 10-year Treasury and the 30-year mortgage rate is coming together, and we're going to talk about why that's happening and what we can expect in the housing market moving into the future. Before we get into it, my name is Liam O'Reilly. I'm a realtor with Jerry Riley Real Estate here in Vermont. If you have any real estate needs in Vermont or anywhere across the country, all of my contact information is in the description. Feel free to reach out to me directly. I would be happy to help you. All right, so let's get into it here. CPI, and why do I say that shelter inflation is being increased by these higher interest rates? Well, we can take a look here. Shelter inflation, I have it highlighted right in the middle here. Shelter, it accounts for 36% of this total CPI number, of this 3.5% number that you've probably seen in the news by now. This data just came out today, where I'm recording this on April 10th, 2024. And I've highlighted some of the other categories that saw inflation increase, that saw a larger year-over-year price change than this 3.5% number, and is part of the reason why that number is being dragged up. Along with housing, food away from home is up 4.2%, electricity is up 5%, tobacco is up 7% roughly, and then some other categories down at the bottom here. Transportation services up 10%, which is pretty crazy. Motor vehicle insurance up 22%, which is just ridiculous. But the biggest thing is shelter. This category that's weighted 36% of the overall number of this 3.5% number, shelter increased at 5.5%. And what goes into the shelter category? Rent of primary residence and owner's equivalent rent. So they don't track home price sales. They don't track the sale of homes or how quickly home prices are going up or down. They track rent and how fast rent is going up or down. And right now, rent is increasing at 5.5% year over year, according to the Federal Reserve's data. Now, why do I say that the Federal Reserve, why do I say that their higher interest rates is actually keeping that number higher than it would be if interest rates were lower? Well, the higher that interest rates are, the higher that the Fed funds rate is, the higher that 10-year Treasury rate is going to be, the yield on the 10-year Treasury. And the higher that the 10-year Treasury yield is, the higher mortgage rates are. Right? With higher mortgage rates, less people can buy homes. And so there's a bunch of people out there who want to buy homes but can't afford to buy a home because, one, there's not much inventory on the market, home prices are high, and mortgage rates are high. So the people that can't buy property right now are forced to rent. And that's why we're seeing rent increase, whether they're getting roommates because they can't afford the rent on their own, or they're just renting a place instead of buying, and they're living on their own. Either one of those categories is still pushing rent up. That's still people in the rental market that wouldn't be in the rental market if they could afford to buy a home. And so I think if rents start to come down or rates start to come down, not only will we see more rental inventory come to the market where developers can afford to take out financing to build more rental property, but we'll also see some of those renters exit the renter pool, move into the buyer pool because now they can afford to buy, which, although home prices, I think, will go up, at least in the short term, when mortgage rates drop, when the Fed decides to cut their Fed funds rates, I think that will relieve some of the pressure that we're seeing in the rental data in these CPI numbers. And so the Federal Reserve keeping their rates high, it's actually putting upward pressure on rents and keeping CPI above their 2% target. Now we can see here, while the things that I've highlighted here are above that 3.5% number, there are a good amount of categories that are below that 3.5% number. We see here new vehicles down 0.1% year over year. Used cars and trucks down 2.2% year over year. So the prices are lower this year than they were last year. Fuel oil as well is down 3.7% year over year. Motor fuel is only up about 1% year over year. So again, below that 2% target, below that 3.5% number. And so really it's just these few categories that have shot up year over year. And the one that carries the most weight is the shelter inflation, which again, the higher that the Fed funds rate is, the higher the shelter inflation will be, because it encourages renters. It prevents people from buying homes, makes things less affordable. It prevents builders from bringing rental inventory into the market, right? Simple supply and demand here that pushes rents up. And I think that's what we're seeing. At least that's my theory in it. Now, how is this going to affect housing? What's going to happen with mortgage rates and the spread on these between the 10-year Treasury and the 30-year fixed mortgage? So we take a look here. The 10-year Treasury today up almost 20 basis points at 5.46%. When I take a look at NEFQ's rate, which is about the best rate you can get here in Vermont, it sits at 6.625% as of the end of the day. Now, I wasn't tracking this since the beginning of the day, so I don't know if this has gone up significantly since this morning. We might open tomorrow at 6.75% or 6.875%, but still it's a little over a 2.5% spread between where the 10-year Treasury is and where the 30-year fixed rate mortgage is. And so when we look at the 30-year fixed rate mortgage back in October, we know that the 30-year fixed rate mortgage was sitting at roughly 8%, between 7.5% and 8%. And we take a look at where the 10-year Treasury was at that time, it was just below 5% for a little while here. So this peak in 10-year Treasury is roughly when we're experiencing the peak in mortgage rates. And the spread between that, you can see here, if the 10-year Treasury is at 5%, and mortgage rates were at 8%, we know we have a 3.5 percentage point spread, a 3 percentage point spread between the 10-year Treasury and the 30-year fixed rate mortgage, where now we're sitting at roughly a 2% spread between the 10-year Treasury and the 30-year fixed rate mortgage. So why is that? Why has the spread come back down? Well, there's a few reasons where people are more confident that the Federal Reserve will cut rates in the near future, and so they might feel more comfortable jumping into these mortgage-backed securities. But I think the biggest reason is that there's less people in the housing market right now because rates are higher. We're seeing less transactions on a year-over-year basis. There's less pending sales than there were this time last year. Mortgage rates are higher. There's less transactions going on in the overall real estate market. So that means there's less mortgage-backed securities being issued, right? The mortgage rate is a free market rate. It's not something that's stimulated. It's something that was stimulated by the Federal Reserve when they were buying mortgage-backed securities. That's really a topic for another video. But now that the Federal Reserve is not buying mortgage-backed securities, the return, the mortgage rate that you can get as a homeowner if you're going to buy a property is proportionate to the rate that an investor is willing to get by holding on to your mortgage. And so right now that sits at New England Federal Credit Union, that sits at 6.625%. And so these mortgages get grouped into a mortgage-backed security and get sold on the secondary market. And those investors, the people that buy those bonds, are the ones who dictate where mortgage rates are. And so now we're with less transactions going into with less home transactions happening, there's less mortgage-backed securities being issued into the market. And I think because of that, we're seeing a lower spread between mortgage-backed securities and the 10-year Treasury, which is why we're sitting at a 2% spread now compared to a 3% spread like we saw back in October. As far as where mortgage rates could go from here, I think this data, it's going to scare investors. People are going to think that the Federal Reserve is going to keep their Fed funds rate higher for longer. The Fed will probably say that they will. If you've watched some of my most recent videos, I think the Federal Reserve is waiting until we have some sort of crisis, most likely in the banking system, based on the stress that they're putting on that system in particular with these higher interest rates. Once that happens, we'll see bond rates come back down, and then regardless of where the spread is between the 10-year Treasury and the 30-year fixed rate mortgage, I do think we'll see the 30-year fixed rate mortgage come back down. Now, a little caveat before I let you guys go, I think that if mortgage rates drop significantly and we see more buyers jump into the market, we see more mortgage-backed securities being issued, then the more mortgage-backed securities there are out there, the higher yield investors are going to demand from those mortgage-backed securities, right? If investors don't want to pay for a mortgage-backed security that's paying a 5.5% rate, because that's your 5.5% mortgage, then your mortgage rate is going to go up to 5.75% to 6%, something along those lines. I've made videos talking about this in the past. Maybe I'll make one in the near future to just inform everybody on this channel. But it's really dependent on the secondary market, and unless the Federal Reserve steps in and buys mortgage-backed securities by themselves, then this is dependent on investors and what investors are willing to pay for this mortgage debt. So, of course, as bond rates come down, the lower mortgage rates will be more attractive for investors. But if we see a flood of mortgage-backed securities into the market because more transactions are taking place, then that could also push mortgage rates up without the Federal Reserve doing anything. So anyway, I hope you guys enjoyed the video. Leave me a comment. Let me know what you think. I love reading and replying to your comments. I learned so much from you folks. Thanks for watching, and I'll see you in the next video.